The global shipping giant FedEx reported second quarter fiscal 2023 results after the markets closed on Tuesday, December 20th. So let's take a look at the critical key figures that investors should know from these earnings results. The main theme of this earnings results were that the e-commerce boom is over for FedEx. The company thrived, of course, when there was a booming online sales environment. That's coming down. Overall revenue in Q2 decreased to 22.8 billion. This was down from 23.5 billion last year. Diluted earnings per share of $3.07 was down from $3.88 year over year. The CEO said the FedEx team moved with urgency to make rapid progress on our ongoing transformation while navigating a weaker demand environment. Now, when a company is moving with urgency and rapidly, I scarcely believe that you can be effective moving with that kind of haste and speed. So I think investors are in for some few quarters of FedEx not operating optimally as it tries to adjust its business. Now, this is no fault to management, and I've been saying this for several companies that were closely tied to the boom from online sales. It's just not easy to run a business that's been going at a certain rate, and then all of a sudden you've got this acceleration in sales, in orders, in activity. It's not an easy thing to adjust to. You might think, oh, that's great, a boom in sales. It's not always the case, and many of the companies that experienced that boom in sales from the pandemic are now reeling from its effects, and FedEx is one of them. It adjusted, it over adjusted, and now it needs to come back down. In its express, ground, and freight segments, it implemented price increases of 8%, 13%, and 18% respectively. These are big price increases for a shipping company as as ingrained in the shipping logistics of so many big businesses around the world. These are big price increases. And of course, they had to do this because of the rising inflationary pressure they were facing, FedEx was facing. So they needed to pass on some of these costs along to their customers. If you recall a few quarters ago, I would say as late as 3 quarters ago, FedEx was complaining that they couldn't get enough trucks, enough drivers to fulfill all of the orders that they were experiencing. And now it's the opposite. Now they're having to park planes and trucks, and they're stopping their hirings plans. And in fact, they've put a cost savings plan underway, and it added an incremental $1 billion in cost cutting to total 3.7 billion in cost cuts for fiscal 2023. So it went from ramping up hiring, adding new cars, adding new partners, adding more fulfillment capacity, to now having to adjust it back downward. And this is what I meant when I said that it's not easy adjusting a business upward and downward with such large fluctuations. It could lead to more problems down the road, and FedEx is experiencing that. For fiscal 2023, the EPS guidance for the full year came in at $13 at the midpoint. This was adjusted. Just to put that figure into context, unadjusted earnings per share was $14.33 in fiscal year 2022. So FedEx is guiding for earnings to come down by $1.33 year over year. This is not good news for investors. They do not like to see earnings decreases, but this is the reality that FedEx is in right now. The company boomed when there was a sales explosion online, and now that folks are not spending money online as much anymore, they're spending money on away from home experiences like travel, theme parks, concerts, ball games, and so that's decreasing the volume in package deliveries, even though FedEx has raised prices across the board on its services. All right, so that's all I've got for this FedEx earnings update. Those were the critical figures that investors need to know. If you're subscribed to my channel, I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.